Let's bring in former Treasury Secretary Larry Summers for his insight. Secretary Summers, thank you very much for being with us tonight. And I just want to begin with your level of concern. I mean, we have more banks tonight on the brink. What should the American people be preparing for?
I don't think this is a time for panic or alarm. This is not 2008, where people needed to be worried about whether they could get their money from the ATM machine. It absolutely is not that. There may well be concerns at certain banks, and they may even be more bank closures. But the government's made it clear that it is determined to ensure that all depositors will be able to get their money promptly and in full. That's what it signaled with its actions at SVB, the Silicon Valley Bank, and Signature Bank, and with the support that it provided to the banking system more broadly. Mm-hmm. It's not just people with insured deposits under $250,000 who will be able to get their money back. It's people with money over $250,000. Right. So there are real issues here. There's major failures of financial regulation, but this should not be something that causes panic or consternation or fear among your viewers.
You know, it is so significant, though. Roger Altman, who worked in Treasury, during the Clinton administration, deputy while you were there, he called it to us this week breathtaking, what the government has done here, stepping in this way. And now the question becomes, Secretary, what does the Fed do? What does the Fed do next week on interest rates, given their dual mandate is maximum employment and price stability, but they know whatever they do if they raise rates will really impact bank stability right now?
Look, I think the Fed has no choice but to remain focused on the inflation issue. If inflation goes up and inflation is not controlled, we're going to have higher interest rates, and higher interest rates are going to make these problems more serious. The judgment the Fed's going to have to make is that because of what's happened, there's surely going to be some reductions in the supply of credit. And so, in a sense, without the Fed raising interest rates, monetary conditions have tightened. And the question the Fed's going to have to ask itself is, have monetary conditions tightened sufficiently that we're responding to the inflation threat without any further rate increases, or without a further rate increase this month? And I don't think we can know the answer to that question with confidence. And every day we're getting new information as we see what happens to banks, as we see how businesses are responding to these developments. Certainly the 50 basis points that I and others thought was a viable option before all of this financial difficulty, that has to be off the table. But I would be concerned if the Fed were to stop altogether raising interest rates, that it would be sending a signal that it was quite alarmed about the economy, and people would feel that if the Fed was alarmed, they should be alarmed, and it could be counterproductive. So I don't have a clear view right now. My instinct is that if they can find a way to safely raise rates by 25 basis points, that's probably the better thing to be looking for. But that's not a judgment that one can confidently make right now.
That's a great point. I mean, they sort of have to get it right, like a Goldilocks decision here. Sheila Bair, Christine Romans, as you know, the former head of the FDIC, said the Fed should pause completely on raising rates. What Secretary Summers is saying, no, you're going to spook the markets. You have a question for her.
And, she's not the only one who said they should pause altogether. But I'm wondering, a week ago, inflation was still issue number one for the typical American family. Tonight, issue number one for the typical American family, if you look at Google search trends, is my money safe? Should I move my money? A lot has changed in the past week. Talk to us, Secretary Summers, about the inflation fight and how that should still be in the forefront of what the Fed is trying to do, in your view.
Look, Americans' money is safe. Americans' money will be safe if they don't raise rates at all. Americans' money will be safe if they do raise rates by 25 basis points, because the government has indicated that it's standing behind bank deposits. And as that message is repeated and becomes clear, as people see that those who've deposited money, even in the banks that failed, and even the people who were not insured, are getting their money back in full. But we are still also seeing very substantial rates of inflation. And if those substantial rates of inflation continue, they will erode people's purchasing power and their ability to spend. They will be incorporated in yet higher interest rates, which will mean further financial strains. So I think the Fed has to tiptoe very carefully through what is certainly a minefield at this point. But again, inflation is a real threat.
Yeah.
Not being able to get your money out of the bank is a fear, but it is not a realistic possibility or a realistic threat that Americans are facing.
Phil.
I think one of the things that I've been trying to figure out through the course of this week, speaking personally, was stunned by the scale and the speed by which the government reacted and coalesced around the systemic risk exception and using 13.3 for the Fed facility. What else do they have in the chamber, to use a bad analogy? When you're thinking about what might happen next, if something happens next, what else can they do that should give people confidence that there's more left?
Look, they have done a huge thing. It is a major source. If somebody was prepared to loan money against a $300,000 house, they were prepared to loan $400,000. That would be a major source of support. And that's in effect what the government has done by saying it's going to lend against all these bonds at par, not against their current market value. So what the main thing the government's going to do is show that it is money good behind its words. And I think that will be reassuring on the question of deposits. Ultimately, one could imagine extending an FDIC guarantee in a formal way to all deposits as a matter of logic. I would be very surprised if that was necessary at this point. I don't think the real concerns here are about deposits. They'll get paid. The real concerns here are that the banking industry is under considerable stress, that they were too bold, that they're going to be regulated more heavily, and how we do that without precipitating a credit crunch that generates a recession. That is the very serious concern that we have here. And so I am much more concerned about a continuing strong flow of credit in the United States and around the world than I am the health of depositors.
Secretary Summers, thank you so much for helping everyone understand the risks ahead, but also what is safe tonight. We appreciate your time very, very much.